All right, welcome back inside our proactive newsroom. And joining me now is Sean Dranfield. He is the CEO of PT Asset Management. And Sean, good to see you again. How are you?
I'm very well. Thanks for having me, Steve.
Yeah, good to have you along. We want to talk about the Trust Total Return Bond ETF in just a second. But first, I thought it'd be a good opportunity to talk about things in general that are happening in the markets. And every time I talk to people, the one word that continues to get thrown out is volatility. And we've seen it, for the last few years, and we continue to see it. It's a word that just won't go away.
Yeah, I mean, certainly we've had our fair share of that this year, largely driven by, concerns around the global economy, trade, et cetera. We all know that story. What's really fascinating, though, about the bond market is despite the fact that we have this sort of backdrop of perceived sort of chaos, the actual bond market hasn't been as volatile as it has been historically. So, for example, would be like the 10-year Treasury. It peaked at around 480 in the middle of January. It bottomed just sort of before Liberation Day. And it's come up a little bit since then, but sort of from peak to trough in the 10 year, it's moved about 80 basis points, which historically speaking, actually isn't that volatile in terms of an intra-year move. Now, having said that, I think some of the volatility has created some opportunity though as well.
Is it the fact that people feel it's more secure or more safe, and that's the reason why there's less volatility, you think? What's the reasoning behind it?
Yeah, I think it's a little bit of that. I would say generally speaking, bonds tend to be a little less volatile than equities, right? So like if you were the most unlucky guy in the world and you bought the 10-year on April 4th, right? When rates were as low as they were, and I think they peaked at around 459 roughly a week ago, you're only down roughly 3.5% from trough to peak. Whereas if you think about the stock market, right, from peak to trough in the S&P 500 this year, you're looking at about 18% down. So I just think bonds are generally a little less volatile. And one of the primary reasons for that, and I think people miss this on bonds because bonds are just simply math, right? So back in 2021, when rates are really low, the coupon you're getting on a bond is de minimis because rates are so low. Well, rates are a lot higher now. So that coupon income tends to sort of offset or subdue any price volatility, which means that you get a smoother ride with bonds generally because rates are a little higher.
Sean, how do you sort of talk to people about bonds and the importance of them? Because people may not understand what they are and how they work and why they work in the certain way that they do. How do you sort of share the information with people so they have a better understanding?
Yeah, I mean, I think diversification is like a key point, right? So typically, and this is not always the case, and 2022 is a good example of it not always being the case, but typically bonds with no credit risk, so call it, government bonds in Canada and the US, wherever you go, they tend to be negatively correlated to stocks, right? So you get that generally speaking, you get that diversification benefit when stocks zig, bonds tend to zag. Now, if you throw in credit, credit tends to be correlated with the stock market. So a high yield bond anywhere around the world, if the equity market is down, that's typically down as well. So I think that's one of the key benefits of bonds. It's not always the case, but frankly, Steve, it's really rare that you get a correlation between the two asset classes. And
Okay.
then also, there's a big sort of knowable income component, right? And
Mhm.
that's a key difference between bonds and stocks. Like the dividend on a stock, you don't know what it's going to be. Whereas the income stream on a bond is a contractual obligation. It's a known. So I think those two things tend to lend sort of less volatility and a more sort of steady Eddie type total return to a bond. And I think it complements other holdings that people tend to have.
Okay. Sean, tell us about the Performance Trust Total Return Bond ETF.
Yeah, so we're excited that it's around. It's been around for roughly a year. It's sort of a best ideas type fund for us. It mimics in some way our flagship fund that was launched 15 years ago in the U.S. And we're excited to partner with Han and deliver something to European investors primarily that gives them access to the U.S. bond market. The key thing that we offer, I think, that a lot of other bond funds don't is we're rate agnostic. So we don't believe anybody can predict interest rates. Frankly, Steve, there's overwhelming evidence that no one consistently can. So we try to build a rate agnostic bond fund by combining bonds that might help you if rates go up with bonds that might help you if rates go down to create more of a steady eddy total return. And I would say most of the traditional bond funds out there tend to look like a lot like the index, and the
Mm.
index is full of rate sensitive bonds. So you're basically making a rate call. If rates go down, they do well. If rates go up, not so well. So I think for European investors who tend to have a lot of money in government securities, investment grade corporates that tend to be highly rate sensitive, we can
Yeah.
offer sort of a smoothing of their total return. And I think that's exciting to a bond investor.
Fascinating stuff. Sean, thanks so much. Great to see you again, and appreciate the insight and also telling us on the ETF as well. Very exciting times.
Thanks very much, Steve. Appreciate you having me.
All right, there's Sean Dranfield. He's the CEO of PT Asset Management.